All right, guys, welcome to this collaboration. My name is Jason. My channel is JMac Investing, as you all know, and we have Mr. Fired Up Wealth is the channel. Eric is his name. Um, so it's going to be pretty cool. We kind of have some similar investing strategies, and he has a little bit different approach. But I think that's the good thing about the investment community. We can all learn from each other. So just a little bit about me for your channel. People on your channel that don't know me, I'm a dividend growth investor. I'm married. I have a couple kids. They're spread out. I got a 10-year-old and a 2-year-old, so it's kind of crazy in my house. Still got one in diapers. Uh, and yeah. So I I'm a really passionate investor. Dividend growth. I mean, that like really kind of that my screening starts there, and then that's when you get on my watch list. Companies get on my watch list when they're a dividend growth company. So, but yeah, it's pretty much me. Just a little bit basics about me. How about you?
Cool. Yeah, my name's Eric, and I also have two kids, two girls. One's about two, so about the same age in diapers, and I've got a four going on five, so
Okay.
about 3 years apart. And I've been investing for about 20 years. I'm just hitting in my early 40s, and I'm pretty close actually to being able to retire off my portfolio. I started with growth stocks and started small and built it. I know we were talking earlier. I got lucky with some of the tech stocks like Amazon and things like that when they were a lot less expensive. And then recently with some of the cannabis stocks like Aurora Cannabis. So I try to use growth to outperform. Have some of those multi-bagger type stocks, sell the profits on those, and then take the profits and I buy DGI. So my focus, my end game, I call it, when I retire off dividends, is going to be DGIs just like you, as well as ETFs. So I'll have a core position of ETFs and a core position of dividend growth stocks. And my plan is to actually live off those dividends and never sell any of them. So no 4% rule. Actually be able to leave that, it's in a taxable account, leave it for my children and never hopefully have to spend any of the assets. So uh, DGI is my ultimate end game. Just basically a little different approach to get there by using some growth to outperform,
Well,
sell the profits, and then put it into those blue chips. So
right. Well, I mean, you've had all of that success doing that, so I'm pretty sure you're. Whereas I think my strategy would I probably will also add if we have a huge pullback. I think I'd probably create another pie with growth stocks. If we had like a big, everyone's calling for recession or whatever, blah blah blah. But if we had a 15-20% pullback, I would definitely add some growth stocks because they would fall pretty hard, and
right, yeah,
I could see entering some positions looking forward like that.
absolutely, yeah. They're always the first to get hit, and usually the first to rebound. And even you look at last December, it was the same way. Buying some of those stocks that are now up 30-40% easy. So yeah. So with that, with all the talks and fears concerning the potential recession coming up, what are the things that you typically do to adjust your portfolio, if any?
Yeah, actually, for the most part, I mean, I'm still kind of really building out my dividend growth portfolio. So really, I passively have been investing for about 6 years, and then the company I work for, I had an employee stock purchase program, and I was able to buy some individual stocks that was with 3M at a
That's good.
discount. So I had a decent little. Um, that was the first individual stock I ever purchased, and we were talking before, and I cashed it out to kind of build out my original portfolio, and I cashed out around 220, which is kind of cool because um, and I really didn't know at that time. Because I know even at that point, it was like one of the most popular dividend growth stocks. And so I was questioning even selling it at that point, but I wanted to diversify and not just have one holding, so I used it as a way to do that. But so I'm still building up my portfolio, but I have taken recently a couple steps. I actually sold out of like a couple of my positions that were up 30%, like Starbucks and Microsoft. I sold out of those positions, and I'm I initiated a 5% pie that is a it's pretty much an ultra short income. It's iShares version. There's a couple of those, like JP Morgan has one. iShares ultra short is ICSH is the ticker symbol on it, and it pays 2.6%, 2.66 monthly, and so that's my cash hedge. It's in M1 that way, rather than having it in a high yield bank account, whatever, I just hold it in my portfolio, and it pays monthly. And then once, like we were talking about, if there's a big 15, 20% drop or something like that, that's when I would deploy that, and I'll keep building about a 5% cash position. Other than that, I'm dollar cost averaging just the whole way.
Yeah, that's a good way to do it for sure. I
Yeah.
kind of do the same thing. I always dollar cost average. I usually do 4 to 5, at a minimum. So, 20% at a time. If you want, $10,000 of a stock or whatever the number is, you buy 2,000 at a time, or do the math however you want. You want 5,000, buy 5 different, positions of it. But that usually works pretty well, and it's really hard to time the entry point if you don't dollar cost average. So it's easier that way.
Right, right, for sure, for sure. That's cool. So no real positioning otherwise for you right now with.
Well, no, I mean, I'm the same way. I did actually, when we were at, the high 2900s, I did sell about 10%, mostly the growth stuff. So at DGI, I usually don't touch it. So I'll sell the growth stuff because obviously, those, like we mentioned earlier, those are the first to get punished, and they don't pay a dividend. It's one thing if you've got an AbbVie paying you a 6.5% dividend, and it goes down in a recession, you're like, hey, I'm buying more shares. As long as that dividend's safe and you believe in the company long term, you kind of like get excited, like, hey, my dividends are going to be buying more shares. But when you own Amazon and and it goes down 50% or something, you're just stuck with it, bag holding it until hopefully it goes up. So I did shave about 10% cash, and I did buy some of those beat up DGI stocks. Like I bought some AbbVie and Bristol Myers. There's a few others that I kind of like, but I try to hold 5 to 10% cash usually as well. And it's in a bond. It's in a sweeping bond fund through Fidelity that pays about a 1.5% tax-free yield, so it's not too bad.
Okay, very nice.
Yeah.
Okay, and so, well, what are your thoughts on the economy at the moment? Like, do you have any inklings or impressions on, like, is the recession coming, or what do you think?
Someone asked that the other day. I think I posted. It's kind of like saying, do you have to go to the restroom? Not right now, but eventually you will.
It's gonna
Eventually,
happen. Yeah.
eventually, but no one really knows. I mean, it's inevitable. Is it going to be a year or 2 years? I don't know. This whole yield curve inversion is unique, I think, because it's one of those things where we've never had rates this low. I mean, you've got the German, Bunds pay a negative, yield. So you give them money and they give you less back in 20 years. I mean, that's not a good deal. So of course, all the money is going to flood into the United States, and that's why the bonds are, the prices are getting driven down, and we've got some weird stuff going on there. But I think it's just a different time. Obviously, there's a lot of turmoil with the trade war, but every time you look at the numbers, I mean, now retail this week we had strong retail numbers from Target and from stuff that you wouldn't even expect, like Nordstrom and Dick's Sporting Goods. So I mean, the consumer is strong. There's a lot of fear in the market, and the fear itself could drive us into recession. That's the problem. But I think at this point, for me, as long as I believe in the companies that I'm in long term, and I have some cash. So if we have a major correction, or some kind of recession, I want to have some cash to be able to buy, so I at least feel good knowing I got something on sale. But my plan is still, 5 years out for a lot of those growth stocks. So pretty much stay in the course for now. In fact, I bought a bunch of cloud kings and cloud type stocks today, 4 or 5 different companies. So I think we'll still have a run up, and I feel like we're probably going to push that 3,200 mark, and maybe we'll have another pullback. But I've been saying that for a while, that we're basically flat from a year ago, 28.50, 28.50. At some point we either got to go backwards or forwards. So I think we'll probably break that 3K and 31.50, something like that. But that's just my hunch. No one really
Right.
knows.
Yeah, I mean, I'm like you. I think the U.S. economy is still strong, but I think there'll just be um, volatility until we get past the elections, because there's going to be all the rhetoric that goes on with elections. So there'll be market sentiment will get shaken and stuff like that. But just because, like you said, the earnings, I mean, yeah, Lowe's and Home Depot and they're all, I guess Home Depot maybe lowered guidance a little bit, but they still beat earnings pretty handily. Lowe's killed earnings. Yeah, so the
Yep.
U.S. economy is fine in my opinion right now, but um, yeah, like I said, especially like the healthcare for all. Once those topics start getting discussed, healthcare probably drop 10%. There's going to be lots of volatility
Yeah.
leading up to the elections. Yeah,
Yeah. Absolutely. Yeah. And that's the thing. You got to remember there's a election coming up too, and that's always gonna make the market a little crazy as well. So.
yeah, no doubt. Okay, so the next one we got on the docket is when do you add your current positions? What criteria do you use to make that decision, and what prompts you to add a brand new position to your portfolio?
So the that's kind of it's tough because I basically have different pillars within my portfolio. So I've got a DGI, I've got an ETF, I've got growth, and I even have cannabis as a separate pillar within my growth. But when you think of something, like for DGI, I like to have, the PE ratio in check. I like the dividend payout ratio usually under 50% when I can, just because usually that's going to stimulate more growth, more R&D. I like to have yields that aren't quite as high for most of them. Like I try to keep it below 3%, just because typically those stocks tend to grow a little bit more as well. But I do have some AT&Ts and some AbbVies and some Altrias and things like that with higher yields, Cardinal Health, to kind of balance that out. And I kind of use those high dividend stocks as kind of like my bonds. I just instead of a 1% yield on a bond, I can get DJI stocks. But in terms of what prompts me for brand new positions, it's a really good question, and it depends on the pillar. Like for the growth stuff like cloud, usually it's intuition, being in the industry. I've been in the industry for a while, and so like right now the hot topic, CDNs. So if you're familiar with CDNs, you've got like Fastly, which has been on a tear in the last week, 75%. You've got Cloudflare coming up with an IPO in fall. Usually it's those kind of secular growth trends that I look for, and then I try to use fundamental analysis as well as technical analysis, which makes me a little bit unique. I do the fundamental research, decide I like a company, and then I'll actually put it on my buy list, my shopping list, and I'll wait for a pullback. But I typically will use technical analysis to try to get my entry position, still dollar cost average. But I'll actually chart out, a stock and say, okay, well, based on where we're at with the 50-day and with all these different variables, here's where I think my entry point should be. And I think most people do that to an extent, but I do use technical analysis in a lot of detail usually to buy my new positions. So.
Gotcha. Cool. Have you done videos where you're breaking down some of the growth stocks that when you're interested in them, with as far as like how you approach that? Do you have any videos like that?
So right now we've got a top five. It's a top 25 stocks that go off the top five secular growth trends. 5G, autonomous driving, which includes kind of AI, legalized, marijuana, cloud, and then fintech. And those kind of break down the stocks from a fundamental analysis. I've got a few videos I've done out there where I do some chart technicals. But to answer your question specifically, that's kind of in the plans next to kind of go into, here's how I do it. I did a Boeing video recently where I looked, again, it's mostly fundamental analysis. I looked at a chart and did a little technical, but that kind of dug into like the actual financials and the earnings report, the officers, things like that. So I've done it from a high level, but I definitely could do more videos and deeper dive. I think I only
Well,
have like 15 videos at this point, so I've got a lot of work.
okay.
Yeah.
That's right. That's right. Um, yeah. The only reason I was asking because I'd be interested in watching kind of an analysis and like someone screening on a growth stock because most of my stuff is all dividend growth. So I'd love to see another perspective. You know what I mean?
Yeah,
So
absolutely.
I definitely watch. So
Yeah. No, I mean, with those growth stocks, the biggest thing for me usually is, is it going to be around in 5 years? What are the secular growth? Like 5G we talked about earlier. I mean, there's a lot of companies that are going to benefit from 5G, and then you got to decide which ones you like the best. There's a lot of research to do on those, but for me, a lot of times it starts with kind of that gut check. Costco 7 years ago, we went there for everything that we bought for groceries and stuff. And I was like, we need to buy some Costco shares. And that, 7 years, it's just been on a tear. But, a lot of times that's how you get the idea, something you actually like to use. So, you go to the store, it's busy all the time. You're like, this is a cool place. And then you actually do, more research, do your homework and say, hey, why don't I already own this? And then you end up buying it. But that's a lot of times where it starts, even with the growth stocks, is it's like CDNs right now. I can say with confidence that there's a lot of money to be made in the cloud space. There's a million companies that a lot of them you don't even know what they do. But like with this Cloudflare and Fastly, there's going to be other ones that are going to enter cybersecurity. I mean, as you know, you're in software as well. I mean, those are going to be unstoppable. It's just a matter of finding the right leadership team, the right financials, and putting it all together, and you've got a winner.
right. Gotcha. Cool. I guess so. For me, pretty much I take so adding to current positions. I basically because I do dollar cost average, and yeah, weekly. So I pretty much just I flip my portfolio by um, ones that are down the most. And it's because, like I said, I'm still really building out my portfolio, and so I want to get it to a point where I just am investing and it's getting allocated to the percentages in my portfolio. But
Right.
there's when there's great companies on discount, I continue to sort of build out those positions into where my yield on cost will be really low.
Right.
Um, or I'm sorry, where it will be, it'll grow and be higher as
Right.
because I'm getting them in at such good, you
Exactly.
know, yeah, good amounts right now. So that's kind of how I add to current positions is the ones that are down the most, I'm adding to those.
Yeah.
And then, then sometimes it's just on some companies like Costco. I mean, like so kind of some of the growers in dividend growth are like the McDonald's, the Pepsi, even the Microsoft. Those ones, they're growth but dividend growth as well, and those ones have fewer chances of them being down. So sometimes if I'm building out a position, then I'll buy it even on its way up. You know what I mean?
Yep.
But that's more few and far between. I'm mostly looking for more value. And then new positions are um, like in certain areas. Like recently, when I was examining my portfolio, I only have one basic materials position, which is Albemarle, which is a lithium company, lithium production and mining company. Um, so I basically went really deep into that sector to try to find a couple gems and to kind of bring a little bit more diversity to my portfolio to have so I have something a couple companies from every sector. And I found a couple actually uh, there's actually one company that is really under the radar. I mean, not necessarily under the radar. There's just not much info on it. And Linda is the name of it, I believe. It was Praxar, and I may be mispronouncing that, but Praxar was a dividend aristocrat, and Linda was a German basic material company, and they merged, and so the market cap's like $108 billion. And if you look at EPS on that company, it's basically air, nitrogen, those types of chemicals. Anyway, and I was like, and I tried to tried my best to find articles and research the company, the fundamentals, like you're saying, of the company. Not much out there.
Right.
Um, but I kind of went with my gut, and so I added it to my portfolio.
Yeah.
Um, and a lot of it was just off of the EPS projections over 5 years. It's like unbelievable, like 20-30%, like just crazy growth. Um, so yeah, I mean, it really just comes down to, um, if I find something that is really undervalued, or like in this case, I'm trying to diversify.
Right.
That's when I'm adding new positions. But I want to get it to a place where I know you said you have what 150 holdings or something.
Yeah. About 150. Yeah. Right now.
Yeah, I mean between my two portfolios, I mean maybe 80 or 90 holdings too. So I probably hit a point where I really don't want to add too many more positions. You know what I mean?
Yeah.
But always looking for opportunities, but probably it'll be more few and far between. As time goes on.
That's an interesting point you made because this was a discussion in one of our groups, on Facebook, not I think a couple of days ago. But the reality is that everybody has their own path, and you can listen to people like us and learn, but you should take nuggets of information from lots of people and make your own path, make your own journey. My point I'm making though is there are people who are arguing about how you shouldn't have more than X amount of positions. Some people will tell you to have 400. Some will tell you to have no more than 10. Do whatever works for you. For
Yeah,
me, doing it for 20 years, I've always had over 100 positions, and I've pretty much outperformed the S&P every year consistently. So, it works for me. Doesn't mean it's ever going to work for other people. And even some of the moves that I make are, risky where they might not make sense. Like Aurora Cannabis, when it was $1, everybody said I was going to lose all my money, and it's just sometimes it works, sometimes it doesn't. You only have to win more than you lose, and you're going to be ahead, and that's the name of the game. So I buy a small, I hedge positions 1% of my portfolio, usually 1 to 3% max in each position, and that's why I have so many holdings. So if a GE happens and it cuts its dividend or it tanks or it goes down 50% overnight, I'm hedged. You can say, well, why not buy an S&P 500? Well, you could do that, and for some people that's good. But there's 630,000 or so stocks in the world that you can invest in. So limiting yourself to 500 and saying that you should just buy the S&P 500, there's a lot of stocks you can pick to outperform, and there's a lot of
right.
different players, like even some of the ones you mentioned that are foreign and things like that that aren't going to be in the S&P. So do whatever works for you, but there's a million ways you can, get to the finish line. So
Yeah. Yeah, I don't know if you follow along with Finn Carlin. He's a content creator. I don't know if you.
yeah, I've seen him. Yeah.
Yeah. So I mean, yeah, different, definitely different than most channels and stuff where he really sprawls out and tries. I don't know what country he's from, but he has a much you know better perspective on global investing than most of us. So yeah, like you said, there's opportunities that we wouldn't even know anything about that are just sitting right there right now. Right, you know what I mean? So yeah,
Yeah.
always I agree with you. Definitely always kind of keep. I try to keep an open mind and try to keep feelers out for not something like the new and the the shiny things, but look for just possible hidden gems that, and they may not just to even to many other people they may not be hidden gems, but knowledge is only knowledge when you possess it. If you don't possess it, it's
Right. Yeah, and it depends on your goals and your strategy. I mean, for me, almost all of my assets are in a taxable account. I have IRAs and things like that, but the majority of the wealth that I've accumulated is in a taxable brokerage account. And so if I invest in a REIT or an MLP, like an oil company or even an international foreign stock, the tax ramifications are significant. And so I have to know what I'm getting into before, it's got to be what they call a qualified dividend. And if it's not, I can get taxed, a lot more aggressively, and I'm in a high tax bracket. So I've got to really be careful on not only when I'm selling something, if it's a long-term or short-term capital gain, but also if the dividend's qualified, and then also have to be, careful with wash rules. If I sell a stock and buy it back, now if I sell it for a loss, now I can't write that off my taxes, and it's happened before. I've made the mistake. That's how I learned.
Yeah.
And it can really kill you. So, if it's in a Roth IRA, whole different ball game, and you have a lot more flexibility there. So everybody's going to have their own strategy, their own path, and that's it's. I think it's really important to bring that up to people, because a lot of times they just assume everybody's investing in a Roth IRA or the same type of account, and there's a lot of different situations out there depending on what you're trying to accomplish. So
Yeah, I agree. Yeah, my largest portfolio is also in a taxable account for the same reasons as you. I hope to retire before retirement age, right? So
right,
so I want to have
exactly.
access to it, all of it.
Yeah, exactly. Yeah. So and if you want to retire young, I mean, a lot of people don't think of that, and you got to think about how it impacts your Social Security. A lot of people in the whole FIRE movement. So Fired Up is financial independence, retire early with dividends. I should have mentioned that earlier. But the end game goal again is dividends. But when you think of retiring in your 30 or 40 on the FIRE movement, they're not always using dividends to do that. They're using the 4% rule, and eventually they might run out of money. So it's a lot different strategy than what F.I.R.E.D is. Um, but it's just everybody's got their own path for sure. So
Yeah,
it's good.
yeah, no doubt.
And for you, I mean, what are your long term goals? With your strategy, it sounds like also to retire off dividends, and tell us more about that, I guess.
Yeah, yeah. I mean, so I just hit 40, and like I said, I was probably investing in 401k for 5 or 6 years, and then really hard hitting it hard in individual stock investing for 6 months now. Um, so the goal is to hopefully, worst case scenario, by 55 retire. Um, but I'd like to accelerate that. It just depends on how the industry I'm in. If I can continually, you know, increase my salary, where I can increase my savings, then I
Right.
could probably I may be able to pull it off by 50. But 55 would be max, probably what I'm aiming for. And that's about the time with I got a 2-year-old, so she'll be kind of
Yeah,
getting older, and
right.
as well, and all those kinds of things. So
Yeah.
but yeah, and then like it's that's just like, I mean, I know as well, because that's where your end goal is with dividend growth. But it's like you'll be getting a raise, every year on
Mhm.
your income coming in from dividends. So every year, um, it's that's just an awesome thing to be in a bunch of companies, and then the longer you stay in them, the bigger your income wealth is. So
Right.
um, yeah, so it's a good strategy for for many reasons, but I mean, for because while you're not taking from your portfolio, you're investing all along the way through dips, through ups and downs. That's the compounding just accelerates during downturns
Right.
where everyone else is fearful and scared to invest. There's dividends are you know really
Yep.
holding up your portfolio. So
Right. There's two things that a lot of people, both of us are interested in early retirement. So, I mean, we have very similar strategies. I mean, but there's two things that when I talk to the younger investors that are just getting started out that want to be part of the FIRE movement, a lot of them want to retire in their 30, and, they're really aggressive, and that's fine. But for me, like, I wanted to kind of have a balance where I could still kind of enjoy my life, enjoy my 20s and 30s, retire in my 40s, not be as aggressive. And it's kind of a, compromise, and it's a best of both worlds, in my opinion. But the two things that people need to think about, number one, is how it impacts your Social Security. And some people might say, well, I'm never going to get Social Security anyway, blah, blah, blah. But it doesn't impact your Social Security, because look into research how you get paid on your Social Security. Your Social Security will use your top amount of years. I think it's 20 years. And so when you retire early, that is going to impact the amount of Social Security you get. So you got to be really strategic in how you're doing that. The other thing is healthcare. Healthcare, if you retire in your 40s or whatever, some people are paying $1,500 a month in healthcare. You need to budget for that because you need private insurance. Um, so those are two things I think that are overlooked a lot of times. Hey, I've got $1 million, I can retire. Well, can you? Like, if you have any health conditions, or if your insurance is high, depending on your state, all these things. And then a lot of people forget about Social Security and how that actually will impact their Social Security payouts later in life. For me, that's never impacted my decision, but for some people, it could be significant and they might not think about it. So just something to bring up for anybody out there that maybe is just getting started in that and haven't done any of the research. So good to look into those things.
Yeah, good points for sure. Um, did you want to touch any more on long-term goals or your investment strategy?
No, I think we're good there. No, I
Okay.
think we're good. Yeah.
Um, and yeah, I mean, the next one is which we've really kind of been hammering on as well, is
Yeah.
what you specifically like about the concept of DGI. And
Yeah. Yeah, we've covered that well. I mean, I think the biggest thing is, you know, dividend growth investing. A lot of people they don't understand what that means. You want the dividend to grow every year, and I think the favorite part about it is that, like you said, you're getting a raise every year, but you're outpacing inflation. So your income is going up higher than inflation. Right now, inflation is so low that people don't think about it, but think of like the 1980s, and we could be in that situation maybe again sometime when the inflation, gets high. You want to be able to have DGI where your income is actually outpacing inflation, because if it's not, that's going to have a compressing effect, and it's going to impact your quality of living if you're on a fixed income. So, but that's what I like about dividend growth investing, is that you can invest in something now that pays you a 5% yield, but if you calculate the math of what it's really paying you, over time, it's extraordinary how much money you can really make with compound, interest. And everybody follows Buffett for that reason. But some people say what I'm doing is wrong because it's better just to throw it in dividends right away and have that work for you. Again, there's no right or wrong. It's whatever works for you. So,
yeah,
but yeah. So for the last one, we both probably can maybe cover this, but I was going to ask you the worst investment or trading decision you've ever made. So maybe share a story of buying a bad
I,
time, or maybe a crypto.
yeah. When I was really first building out my portfolio, and I was um, also trying to figure out my investing strategy. It wasn't all right from the get go. I didn't go straight into dividend growth. It was mostly dividends, without the dividend growth perspective on that, which is big because a lot of people, even a lot of dividend content creators, they really are dividend growth minded, but they don't identify as that. But they even like PPCEN, he really is. He's a dividend growth investor, but he just always calls it the dividend community. Well, there's a difference because if you're like a retiree dividend income investor, they're
Right.
not necessarily they're just looking for a consistent dividend. They're not necessarily looking at dividend growth. Um,
Right.
but okay, so but when I was building out my investment strategy, I was dabbling with, like I told you, I tried options. I also tried to get into like some spec stocks and things like that. I got into Neo,
Yeah.
which is the Tesla of China.
Yeah.
I got in. I started reading a few articles about it, and I was like, "Wow, man, I really might actually have something here." And so I got in at like 9.75, right before earnings, right before the earnings that started their crash. Um, and so I don't know. I probably bought a couple hundred shares. Not a huge position at that price, but to me it was. As a really kind of trying to build out a portfolio, and earnings came and I mean, they lost their tail, and so did the stock price. I mean, it's at $3 now, and it really hasn't recovered because they've had a couple more earnings since,
Right.
or at least one more, and it was again terrible earnings. Um, and so I think I sold out at 4.25 or something like that. So I lost. what's that, 50, 60%. And I know they say you don't lose until you sell, but I was like, well, and by that, I kind of stayed in a little while and was figuring out that, I wanted to be a dividend growth investor. I was like, I don't care, I'm going to cut my losses, and so I got out. But that's probably the biggest position I've lost on.
Sometimes you got to do that. I made a video like top 15 investment rules, and one of them is cut your losses early, reposition that capital, because in the long run, you're actually going to make that capital back a lot faster if you put it in a winter versus let it sit there and rot. Because those stocks will trade sideways sometimes for years, and it's a good story. I mean, honestly, I've had a lot of those. But again, that's why I have so many positions, because I'm going to have some that are 500%. I'm going to have some that, I mean, I've had one of my first investments. I was in college, so it would have been 20 years ago when I first started investing. I bought, at the time, it was probably a few $1,000s, and I was a college kid. And, I paid $100 a month for rent. Like back then, or so it was really cheap where I went to school. And I put in like $3,000, which was an ungodly amount of money back then, in a company called Colorado MedTech. So biotech,
Right.
CMed, I think was the ticker, and I lost every penny on it. It was a E-Trade account, and I remember getting a letter from E-Trade like, we're closing your account because you got no money, so have a nice day. But yeah, my very first deal, I went in. And there's people that do this every single day. You see it on Facebook. What should I buy? And then someone gives them buy this, and they go buy it. And I took all the money I had and I put it in one speculative stock, and I lost all. And I learned in a hurry that, number one, I need to diversify the hedge. So if I'm going to do that again, I'm going to put it in at least 5 or 10 different companies, not one. And the more you invest, as you get older, and like you said earlier, you save more and you earn more. You're investing in larger dollar amounts, and then it's easier to be able to have more positions. If someone's just starting out and you've got a Robinhood account and you've got $2,000, and you hear someone like me say I've got 150 positions, you're like, who's this idiot? Trust me, you'll get there. It takes time. 20 years of grinding, a lot of wins and losses. But I probably have about 10 stories like that. Heck, crop infrastructure was one of the cannabis stocks that just in the last couple of years I've lost 70% on that. I was MedMen. I put a bunch of money in MedMen, probably like $5 a share. Sold it at like $2 a share. That's the beautiful thing about a tax account, though, is that you can tax harvest. So, if you've got 100 different positions and you want to sell something and take profit, instead of taking that profit and having to actually pay taxes into the IRS, I can take a loser like that, sell both of them, take the cash. Now I've got cash to invest in something else. Hold on to it so when the market dips, and I'm not paying any taxes on that. That's another reason I like to have a lot of positions, so that I can play and basically be creative with my tax harvesting. So, but yeah, I've got probably a dozen of those stories where I've lost 50% or more. But for every story I have, I've got 5 where I've made 2, 3, 4, 500%. And that's the name of the game, is just winning more than you lose, and you're going to be ahead. So
yeah, you got it. You got it. That's right. That's awesome. Well, Eric, this has been cool, man. I appreciate doing this collab. I had a good time doing it.
Yeah, it's been really good. I appreciate it. And definitely, if anybody hasn't stopped by the site, it's just Fired Up Wealth, and JMac's got a great Facebook page. I've got one as well. The nice thing about this community is we're not trying to compete with each other. Everybody's kind of got their own, flavor and their own strategies. So, I talk about some of the options and things like that, and more of the risky speculative stuff. And JMac goes, the much deeper dive on, the fundamentals of these blue chips. So I think it's a great collab, and both channels have, add a lot of value to somebody that's just looking to learn about the stock market and get some information on some good companies. So I appreciate putting this together. Yeah.
Yeah, and we'll both post this on our channels, and we'll both, like, I'll link his channel, and definitely go check him out and subscribe, and he'll do the same. So you can check me out too. So
definitely.
All right.
All right.
Thanks.
Have a good rest of your night. See you.
You too.
Yep. See you.